One owner who bought the L60 pretty early on expressed some concerns about having to just put in the extra mental energy and effort to plan out routes to make sure that they go to a station that's going to work for their vehicle. It's not like you can just go to any NIO battery swapping station. So basically, a lot of customers are feeling this pain. They're traveling far distances just to take advantage of a selling point that they had in mind when they bought the vehicle. William Lee, the CEO, has also been very vocal about the fact that things aren't going the way that they need to go because NIO's invested a lot of resources in Onvo. And I think if Onvo is a failure, that's going to look really bad for NIO. There's a lot of people who were riding on this, betting on Onvo to be able to restore faith in the company and get the company back to a position where it's able to thrive and just catch up to the competitors. So if Onvo doesn't succeed, I think it's just going to completely destroy market confidence, and a lot of people are going to walk away from the stock with their investment, and just it won't be good. What's going on, everyone? Welcome back to the Courtside Financial podcast, the podcast where we talk about business and technology. Today, we're talking about two very different competitors facing two very different kind of storms in the electric vehicle industry. It's going to be a super interesting episode. If you're new to the channel, make sure you hit that subscribe button. You know, sometimes the biggest threats to a company don't necessarily come from competitors or technology shifts. They could come from something completely external or outside of the industry. That's exactly what we're seeing with Tesla right now. The perfect storm of politics, protests, and plummeting sales. Meanwhile, NIO continues its dramatic restructuring and restructuring in Onvo as well. As far as leadership, we discussed last week that things are taking an even more significant turn over at NIO. But yeah, that's going to be the direction that we're taking this video in today. So buckle up, guys, because we got a lot to cover, and the industry is changing faster than a Tesla in ludicrous mode. Let's start with Tesla, because what's happening here is honestly unprecedented in modern automotive history. First, the hard numbers. Tesla delivered 336,700 vehicles in Q1 2025. That's not just a slight decline. We're talking 50,000 fewer vehicles than the same period last year. That's a 13% drop. This is Tesla's worst quarterly delivery performance ever. And this wasn't just a slight miss against expectations. Wall Street analysts had already lowered their targets from 408,000 to 373,000 vehicles. And Tesla still came in well below the already reduced forecast. Now, every company faces its occasional headwinds, economic uncertainty, increased competition, product cycles. But Tesla's situation is kind of unique because the challenges they're facing appear to be kind of self-inflicted. And I'm talking about Elon Musk deep dive into American politics. For those who have been following along, and we've talked about this on the channel, Musk has become more than just a donor to the Trump administration. What I'm interested in is the business impact of Elon Musk's political activity, and that impact appears to be substantial. Throughout the United States, Tesla stores are facing protests every weekend. There's been reports of vandalism targeting Tesla stores, charging stations, and even private vehicles. And it's even spreading to Europe, where Musk has been openly supportive of far-right political movements. According to CNN, a recent poll, only 35% of Americans now have a positive view about Elon Musk, while 53% still hold an unfavorable opinion. To put that into perspective, he's now less popular than Vice President J.D. Vance. And remember, Tesla's core market in the US has traditionally been in deep blue states politically, like California, New York, precisely the demographics that feel alienated by Musk's latest political antics. JP Morgan analyst Ryan Brinkman put it bluntly: "We can find few parallels in the history of the automotive industry where a brand has lost So much value in a short period of time. The Cybertruck situation is particularly telling. Before its launch, Musk claimed over 1 million reservations, but a year later, total deliveries stand at just 50,000. And Tesla now has more than $200 million in Cybertruck inventory alone. Used Cybertruck prices have dropped 55% year over year, with a 13% decline in just the past 3 months. It's not just the US market that's feeling the pain. In the first 2 months of 2025, Tesla's European sales plummeted 49% year over year. During the same time period, the overall European EV market grew by 28%. Again, Musk's political statements haven't helped, with his public support for far-right parties like Alternative for Germany, and of course his public feuds with European leaders. Here's where it gets really interesting for Tesla investors. After reports surfaced that Musk might leave his position in the White House, Tesla's stock jumped 5%. This is a clear signal that shareholders see his political activity as a drag on the company's value. But Musk quickly shot down these reports as fake news, I have to add, suggesting that he's not planning to step back anytime soon. In terms of market impact, Tesla stock has dropped around $239, less than half of its December peak, with market capitalization dropping from nearly 1.4 trillion to around 770 billion. Even Dan Ives at Wedbush Securities, who's a longtime Tesla bull, one of Tesla's biggest bulls, cut his price target by 43%. From $550 to $315, and he's acknowledged the brand crisis triggered by Elon Musk political activity. So guys, Ives estimates that Tesla has lost at least 10% of its future customer base worldwide due to these self-inflicted brand problems. And he calls that a conservative estimate. Meanwhile, over in China, the EV competition continues to intensify. If you want to be a part of the conversation before it happens here on YouTube, click that link in the description to join the free Courtside Financial Discord. BYD sold over more than 416,000 electric vehicle passenger cars in Q1, which is a 39% year over year increase. So BYD once again surpassing Tesla, and if this trend continues, Tesla may lose its title as the global EV sales champion for 2025. Let's pivot over to NIO, where the leadership changes we discussed at Onvo last week have kind of taken some new legs. As I reported in our last episode, the president of Onvo had resigned, and he resigned because he failed to meet his self-imposed 20,000 vehicle deliveries target by March 2025, which we are past now, we're in April. But the numbers kind of tell a story. Onvo delivered 5,912 Onvo L60 in January, nearly half of December's figure, 4,049 in February, and 4,820 in March. These numbers are nowhere near the target that the former president of Onvo had set, where he boldly claimed that orders had exploded and made promises of delivering 20,000 vehicles by March. What's particularly interesting to me is Liebman's explanation at NIO's Q4 financial report conference. He claimed, and I'm quoting here, that the recent intensification of market competition and the frequent occurrence of negative public opinion had reduced Onvo's order volume by 30 to 40%. But based on the leadership change, to me, and the feedback from consumers, the problems appear to run deeper. So what went wrong with Onvo? From talking to consumers and analyzing the market, several themes appear to be at play here. First, there's the battery as a service, which, is something that for the most part has been seen as innovative, but it's now being viewed as problematic by many owners. One Onvo L60 owner explained that while the upfront price seemed attractive at 149,000 yuan, the long-term costs were actually higher than competing products. For example, for the 60 kilowatt hour standard version, the battery rental is 599 yuan per month, with a pay four get one free scheme that they've got going on, totaling about 29,000 yuan over 5 years. After that, buying out the battery still cost another 43,000 yuan. And so in total, these costs essentially eliminate the initial 57,000 yuan savings compared to buying the battery outright. So as this owner puts it, the wool comes from the sheep. Another major complaint was the battery swap compatibility. Although Onvo is supposed to share NIO's battery swapping network, which obviously is a major selling point, many of NIO's stations aren't compatible with Onvo vehicles. While NIO has over 3,200 battery swapping stations, roughly only about 1,309 are Onvo compatible with those batteries, and that's as of February. One owner who bought the L60 pretty early on expressed some concerns about having to just put in the extra mental energy and effort to plan out routes to make sure that they go to a station that's gonna work for their vehicle. It's not like you can just go to any NIO battery swapping station. So basically, a lot of customers are feeling this pain. They're traveling far distances just to take advantage of a selling point that they had in mind when they bought the vehicle. What's particularly challenging for Onvo is its positioning. It wants to leverage NIO's premium brand halo while also trying to go after a more cost-conscious consumer. But this strategy has left Onvo caught in the middle. Not fully premium and not exactly budget friendly as well. It's somewhere in the middle. Industry insiders suggest that this type of confusion extends to the company's organizational structure as well. Onvo was initially set up with a significant independence from NIO, its own stores, its own service system. In contrast, NIO's new upcoming brand Firefly will be sold through NIO stores and share a NIO service system, a more integrated approach that might prove to be more efficient. The situation overall raises some serious concerns about NIO's multi-brand strategy and the financial impact that it's going to have on the company. As I mentioned last week, NIO's net loss in 2024 hit a record 22.4 billion yuan. That's over $3 billion. And its current liabilities exceeded current assets by 420 million yuan. This financial pressure seems to be restricting Onvo's development, and it's also making its success more crucial than ever. People are waiting on this thing to succeed. Recent reports also indicate that layoffs are happening quietly across multiple departments at NIO, including after-sales customer service, energy, and NIO house operations. Some sources claim layoff rates as high as 10% company-wide, with certain areas seeing 50% staff reduction. So what's next for NIO and Onvo? Well, the company hasn't given up on its second brand yet. At the end of February, NIO announced its merger of delivery channels for NIO and Onvo and the sharing of after-sales resources, which points to a significant integration, which might be good. William Li, the CEO, has also been very vocal about the fact that things aren't going the way that they need to go, and they are integrating a new strategy called the CBU, Cell Business Unit System, where basically all functions related to R&D, production, and marketing are broken down into 12 independent core units, basically with a focus on ROI. Every dollar spent needs to be heard back is the phrasing, how they put it, how they said it. So basically, things to watch for here is if Onvo can gain steam and gain momentum under new leadership, because NIO's invested a lot of resources in Onvo. And I think if Onvo is a failure, that's gonna look really bad for NIO. There's a lot of people who were riding on this, betting on Onvo to be able to restore faith in the company and get the company back to a position where it's able to thrive and just catch up to the competitors. So if Onvo doesn't succeed, I think it's just going to completely destroy market confidence, and a lot of people are going to walk away from the stock with their investment, and just it won't be good. So let's put these two situations side by side for a moment. On the one hand, we have Tesla, a company that revolutionized the automotive industry, achieved and sustained profitability, now facing a serious brand crisis due to the CEO's political activity. On the other hand, we have NIO, a newer company, still struggling to reach profitability, and they're making tough organizational decisions to streamline cost and consolidate. The contrast is striking. Tesla's issues and challenges stem purely from external issues and leadership decisions unrelated to its core business. NIO's issues are fundamentally operational: how to structure multiple brands, optimize resources, and reach financial sustainability. It's going to be interesting to watch how both companies respond to these respective crises.